Here's a number that should bother you. Most people treat tax season like a fire drill. They panic in March, scramble for receipts, and hope for the best. And by then, it's too late. Almost every good strategy, the tax strategy, has to happen before December 31st, not after. In the next 20 minutes, I'm going to walk you through the exact framework financial advisors use to legally minimize taxes, income timing, deduction stacking, tax advantaged accounts, and investing strategies that can give you can save you around thousands of dollars a year. This is not about loopholes. This is about understanding the rules well enough to make them work for you. Let's get into it. So, let's define terms because tax planning gets thrown around a lot. Tax planning is a proactive, year-round process aimed at minimizing your tax liability and minimizing your tax income, your after-tax income, not a one-year scramble, a continuous habit, and it really comes down to three goals. Number one, reduce this year's tax liability. Number two, defer tax liability into future years and when it might cost you less. Number three, maximize the savings from every deduction you are legally entitled to. Here's a mental model I want you to work with. Tax planning is not a once a year event that happens in April. It's something that should be woven into your financial decisions all year long. Every time you get a bonus, sell a stock, or make a big purchase, there's a tax angle worth thinking about. Okay, with that foundation, let's talk about the first letter you can actually pull when you receive your first income. This is the one of the most underused strategies because most people assure income is income. You can't control when it shows up, but for a lot of people, you actually can. Income deferral first. If you expect to be the same in the or a lower tax bracket next year, it can play to delay income. Two classic example that I'm giving here. If you are getting a year-round bonus, ask if it can be paid in January instead of December. Same money, just one tax year later. If you are self-employed or a freelancer, you can delay billing clients in late December so the payment actually lands and gets taxed in January instead. That's a simple, completely legal way to push taxable income into a year where it might be taxed less. Now, income acceleration and the opposite move. If you expect to be in a higher bracket next year, say you know a raise or a big life change incoming, it can make sense to pull income into this year instead. This that might mean realizing the capital gains before year end while you are still in a lower bracket and exercising stock options before the calendar flips. The key question to ask yourself every December is very simple. Will I likely be taxed more or less next year when this year? That single question determines whether you defer or accelerate. Now, let's move to the second big lever, deductions and credits. Quick but important distinction because people mix these up constantly. The first, deductions. Deductions reduce your taxable income and the amount the government calculates tax on in the first place. The credits. The credits reduce the actual tax when you owe a dollar, a dollar for dollar. A credit is generally more powerful than a deduction of the same size. Now, when it comes to deductions specifically, you have a choice every year. Take the standard deduction or itemize. The rule is simple. Whichever one gives you the bigger deduction in taxable income, take that one. But here's where it gets strategic. What if your itemizable expenses, mortgage, interstate and local taxes, charitable giving, medical expenses are close to the standard deduction amount, but not quite over that? That's where a technique called bunching comes in. That's the bunching strategy you can see on the screen. The bunching means concentrating your deductible expenses into a single year. So you clear the standard deduction threshold and then taking the plain standard deduction in the years in between. So instead of donating $5,000 to charity every year and getting a mediocre benefit each time, you might donate around $15,000 in a year, itemize and get a big deduction. Then take the standard deduction the next 2 years, same total giving meaningfully better tax outcome. This single strategy is one accountants recommend constantly, and almost nobody outside the finance world has heard of it. Speaking of charitable giving, let's go one level deeper because how you donate matters just as much as how much. Most people donate cash, totally fine. You get a deduction for the amount given, but if you are sitting on stocks or mutual funds that have gone up in value, you have held them for more than a year. That's a better way. Donate the appreciated asset directly instead of cash. Here's why. That's powerful. You get to deduct the full fair market value of the asset, not just what you originally paid for it, and you completely avoid the capital gains tax you would have owed if you sold it first and then donated the cash. So, say you bought a stock for around $2,000 and it's now owed $10,000. So if you sell it, you owe a capital gains tax on that $8,000 gain. Then you donate what's left. But if you donate the stock directly, the charity gets the full $10,000. You get to deduct the full $10,000 and nobody pays capital tax gains on the growth. It's genuinely one of the most efficient moves in personal finance. Now, let's talk about the accounts that do a lot of this tax saving work automatically, starting with retirement. Now, maximizing contributions to retirement accounts is honestly the cornerstone for of most tax planning. Let's break down the two main favors. The traditional 401k or IRA, as in the the contributions are made with pre-tax dollars, meaning that reduce your taxable income this year. The money goes tax deferred. You pay ordinary tax income and you pay ordinary income tax when you withdraw it in retirement. And here's the Roth 401k or IRA. Contributions are made with after tax dollars, no upfront deduction. But the money goes completely tax free. And qualified withdrawals in retirement are also entirely tax free. So, which one's better? It genuinely depends on whether you expect to be in higher or lower tax bracket in retirement than you are right now. Lower tax bracket is actually the traditional probably wins. Expect to be in similar or higher tax bracket or want to look in today's rates, growth starts to look very attractive. Many advisors actually recommend contributing to both to hedge your bets against future tax law changes. Now, there's one account that beats both of these in a specific way. Let's talk about HSAs. HSA, Health Savings Account. If you have a high deductible health plan, you have access to something genuinely rare in the tax code, a triple tax advantage. One, your contributions are tax deductible, lowering your taxable income the year you make them. Two, the funds grow completely tax free while they sit in the account. Three, withdrawals for qualified medical expenses are also tax free. No other mainstream account gives you a deduction going in tax-free growth and tax-free withdrawals. Not your 401k, not your Roth IRA, and only the HSA does all the three. For if you are eligible for one and not making it out, that's usually the first place I would point people about almost anything else. Now let's talk about saving for something else entirely, education. If you are saving for a kid's education or even your own, a 529 plan works a bit like a Roth account but for school. Contributions are made with after tax dollars, so there's no federal deduction going in, but the account goes completely tax free. Withdrawals used for qualified education expenses are also tax free. And as a bonus, many states offer their own income tax deduction or credit just for contributing to their state's 529 plan. If tuition costs are anywhere on your radar for kids, for grandkids, or even a future degree of yourself, this is a very efficient vehicle to know about. Now, let's shift from accounts to the investments inside those accounts because how you manage your portfolio matters just as much as. This one sounds fancy, but the idea is very simple. Tax investments that have lost value to offset gains from investments that made money. Here's how the offset actually works step by step. Step 1. Your losses first cancel out any capital gains you realized every elsewhere in your portfolio. Step 2. If your losses are bigger than your gains, you can use up to $3,000 of that extra loss to offset your ordinary income, your paycheck essentially. And here's the step 3. And if there's still more loss left over after that, it doesn't disappear. It carries forward to future tax years where you can use it again. So, Even in a bad year of a particular investment, you are not just eating the loss, you are banking a tax benefit you can use now or later. This is one of the few silver linings the tax code gives you for a losing position. Last strategic piece, and this one is subtle and but powerful too, where you actually hold your investments. Don't confuse this with asset allocation. That's what percentage of stocks versus bonds you own. Asset allocation is about which account you put each investment in. And here's the idea: match the tax efficiency of the investment to the tax treatment of the account. Tax advanced accounts like your IRA or 401k are the best home for tax inefficient investments like taxable bonds, actively managed mutual funds that kick off regular income or short term gains, and under the taxable brokerage accounts are the better home for tax efficient investments, broad market index funds, and municipal bonds. And why does this matter? Because if you hold a bond that pays taxable interest every year inside a regular brokerage account, you are getting taxed on that income annually. Whenever, whether you want it or not, put that same bond inside your IRA and that tax hits disappears until you withdraw your money, potentially decades later. Meanwhile, a tax efficient index fund barely generates any taxable events anyway, so it doesn't need that same shelter. It can sit comfortably in a taxable account. Get this right, and you can meaningfully lower your tax drag without changing your overall investment mix at all. Now, let's bring it all together. Five moves in five moves in order of how most people think about them. One, time your account. Defer it or accelerate it depending on which direction your tax bracket is heading. Second, bunch your deductions, concentrate itemized expenses into a single year to clear the standard deduction threshold. The third one, max out your tax advantaged accounts 401k, IRA, HSA, and at last the 529 in roughly that order of priority for most people. The fourth one, harvest your tax losses. Offset gains first, then up to $3,000 of ordinary income and carry the rest forward. And here's the fifth one, locate your assets wisely. Tax efficient investments go in tax advantaged accounts. Tax efficient investments can sit in taxable accounts. Here's the honest truth, tax law is actually genuinely complex, and every single one of these strategies has fine print, income limits, and edge cases that depend on your specific situation. Nothing in this video is personalized tax advice. Before you act on any of this, talk to a qualified tax professional or financial advisor who can look at your actual numbers. But the mindset shift is the important part. Stop thinking about taxes once a year and start thinking them all year. That single change in habit is where almost all of the savings actually come from. In this video, if this video helped you to think about your money differently, that's exactly what Fintelliq is here for. Hit subscribe so you don't miss the next breakdown. Drop a comment with which strategy surprised you the most. I will see you in the next one. Till then, Bye.